Welcome options traders! I wanted to post another video on trade adjustments. I've had a few people ask about them. In the last video I showed how to use ratio spreads when long calls have moved against you. Price has fallen a little bit and this strategy can allow you to recover much quicker. Well, we can use ratios in lots of different scenarios, and a very common one is with the covered call. And I know we have a lot of traders out there using covered calls, so I thought this would be a good way to show how trade adjustments can make you better. So let's take a look at trade adjustments and using ratio spreads with covered calls. As a recap, remember what a trade adjustment is. It's any trade that alters the original profit and loss diagram. Sometimes you'll hear it called morphing because it physically changes the shape of that P&L chart, and you'll see some examples in just a moment. Now, trade adjustments are usually used when trades are moving against you, and that's what I showed in the last video. But now I want to show you how they can be used to accelerate profits. So again, let's take a look at the covered call as an example. For those who may not know, another little recap here. Covered call is a strategy where you will buy shares of stock. You're going to sell calls against it in a 1-to-1 ratio. So that just means if you buy 100 shares, you could sell 1 call. If you buy 200 shares, you could sell 2 calls, and so on. By selling the calls, you receive cash into your account immediately, and that's a big benefit. You already know that you've at least got that as a return. But in exchange, you have the potential obligation to sell your shares for the strike price, and that will happen if the long position, the person who bought that call, decides to exercise. The covered call is a neutral to slightly bullish position, and that's important to understand. A lot of times new traders think because they're selling a call that it's bearish, and that would be true if you're selling a call by itself, what we call a naked position. But because it's combined with shares of stock, it is not bearish. It is actually neutral to slightly bullish. So what exactly does the covered call do for you? Well, let's take a look at long shares of stock. This is your profit and loss diagram for 100 shares of stock purchased at 100. And the good news is you get all of the upside gains up here. The bad news is you also participate in 100% of the losses. So it's dollar for dollar up and dollar for dollar down. And one of the principles of financial risk management is to avoid extreme outcomes. And long shares of stock is about as extreme as it gets. You can make it all or lose it all. So how could we alter this by the covered call? What will it do for us? Well, let's assume that we use the covered call and we buy our shares for $100 per share and we sell the $100 call for $5. Now our profit and loss diagram looks like this. And it's easy to compare if we overlay our long stock position that we previously saw, and we can see the trade-offs. The first thing to notice is that our break-even point has been shifted lower. When you buy shares of stock at 100, you need the stock at 100 just to break even. But by using the covered call, I could actually afford to have that stock fall down to 95. That's by the amount of the premium that I collected, and still just break even. So it gives me a little bit of a safety net underneath me. Now, there are trade-offs though. Notice that this crossover point right here is 105. And so if the stock price does get above 105 at expiration, our covered call position is going to underperform the long stock. And we can see that because this blue line sits below the red. But if the stock is below 105, our covered call position will outperform it, or lose less. But in any case, no matter what stock price you pick below that crossover point of 105, the covered call strategy will perform better than just long shares of stock. Well, what could a ratio spread do for us? Well, a ratio spread is any type of a spread where we're going to buy an option and sell more against it. So kind of the basic level is what we call a 1 by -2, meaning you're going to buy one option and sell 2. You could do a 1 by -3, buying 1 and selling 3, and so on. Sometimes your broker's platforms might show this as just a 1 by 2, and because it's a ratio spread, you would just know that that second number is actually a negative. But for example, let's say that we bought the $100 call and we sell 2 of the 105 calls. Now that trade by itself right there is going to look like this. That's our ratio spread. And depending on whether it's a debit or a credit, this green line could be shifted up or down, but that would be the basic shape. But the thing that you want to notice, the thing that's so dangerous about ratio spreads by themselves, is that you have unlimited upside risk. And because there's no limit on how high a stock's price can rise, it's really the most dangerous risk that there is in the stock market. Well, how could we use this, though, in combination with our covered call? What we're going to do is to look at strikes where the higher strike call is half the price of the lower strike. So in my example, I was assuming the $100 call was trading for 5. Well, what if we bought that $100 call for 5? But we also found that the 105 call was trading for 250, for half the price. Well, if I sold 2 of the 105 calls for 250, notice that results in a net zero. In other words, it didn't cost me anything, at least outside of commissions. And that's because I spent 5 for the $100 call, but I also collected 5 in total by selling the 105 calls. But what's interesting about this is that if I use a ratio spread in conjunction with long shares of stock, it is not uncovered. And that's because I could look at it in a different way. My long 100 shares is covered by the first short 105 call, but then I also have the $100 call that could also be paired with that second short 105 call. So both of those 105 calls are covered, one by shares, one by the long call. So if I own shares of stock and instead of doing a covered call, I use a ratio spread, this is what my P&L looks like. I get this angled portion between my stock price of 100 and my 105 strike. If we overlay the long stock position, it's a little easier to see what's going on here. Notice that if the stock is 105 at expiration and I just own the shares, I would only make $5. But by using the ratio spread in combination with those shares, I would double it to $10. And that's because I have 2-to-1 leverage between 100 and 105. But of course, there are always trade-offs. So let's take a look at the covered call compared to this strategy of long stock plus the ratio spread. So in blue is my long stock plus the ratio spread, and in red is the covered call. So the first thing to notice is that the covered call gives us a lower downside hedge. And the reason is, in this example, we executed this for a net zero. We didn't get a credit, so our blue line is not shifted left. Didn't cost us anything, but we also didn't receive anything. So the covered call would actually give us a little lower downside hedge. But there's also a crossover point right here of 102.50. In other words, if the stock gets to 105, we would make 5 on the stock. I would also make 5 on the covered call. But because I've got 2-to-1 leverage, I'm going to reach that point in half the distance. I only need the stock to go to 102.50. So for any stock price above 102.50 at expiration, the blue curve, or my stock plus ratio spread, will outperform the covered call. But if the stock is below 102.50, then our strategy here in blue, the long stock plus the ratio spread, will underperform the covered call. So it's always about trade-offs. With options, you never get anything for free, but at least you get choices. So I hope this helps you to see how trade adjustments can help you alter your risk profiles to suit your needs. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsaToZ.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.